released its June Manufacturing Purchasing Managers Index, posting a 52 points healthy rating compared to 53.8 in the previous month. The rating above 50 suggests that the manufacturing economy is expanding in the country. And to review some of the guiding facts behind the index, I'm joined now by Gregory Cranston, fixed income research analyst at FBN Capital. And of course, he joins us from London. Thank you so much, Gregory, for joining us.
Pleasure.
All right, Gregory. So let's talk us through this report. Like you've noted in the report, it's a bit early to begin to make conclusions in terms of trends. But give us your take on the manufacturing space in Nigeria before we delve into the other factors that you've used to rate the growth of the manufacturing sector in this report.
Right, thanks. Well, what we're trying to do here is to add a new economic indicator, forward economic indicator, a type of policy tool, if you like, for manufacturing PMI for Nigeria. You know, Nigeria is, as we know, largest population in Africa, shortly going to be the largest economy in Africa. So this is a snapshot using a very familiar model of the state of the manufacturing sector. The reading you're asking about, of course, is the latest one, which is for the month of June, and we come out at 52. So 50 will be neutral. Right. Anything above 50 indicates the sector is expanding. So we're at 52, and to put that in context, also on Monday, all the main developed economies produce their PMIs, and the big emerging markets as well. And 52 puts Nigeria, well, the highest among those which released on Monday, other than UK, which may be exceptional case, 52 and a half. But we come out at 52, which I think is quite a healthy, sound reading, if slightly off from the previous month.
Right. Do you get a sense that the recent weakness in the naira is worrying manufacturers at this stage? Because we do know that quite a number get most of their inputs from abroad, all kinds of raw materials, hard machinery. So clearly they keep a very close eye on the exchange rate. And I wanted to get a sense of whether or not that reflected at all in this reading.
Right, absolutely. Well, that could be one. Yep, that could be one reason the reading has come off from 53.9 the previous month. But what I would say actually is that we have a fairly representative sample of companies. So in our survey, which is in conjunction with NOI polls, in our survey, it's only 20% of the respondents are what we call large companies, which is over 200 employees. So you wonder whether how many of those below the threshold would actually be buffeted by what's going on in the exchange rate markets, which in turn reflects on possible change in monetary stance in the US. But I'd say yes, the exchange rate will be one reason. Another reason you have to comment on. Well, we are moving towards what you call the electoral cycle, which could perhaps be a second factor.
Right. Okay, let's talk a bit about the impact of Nigeria's borrowing right now. But the fixed income market, we've seen yields rise quite a bit over the last couple of weeks, clearly because of the sell-off we're seeing from emerging markets, Nigeria being hit on that side. But the interesting news today, of course, is the latest on the Eurobond issued by Nigeria. So successfully raising $1 billion at 5.5% and 6+% for the 5-year and the 10-year. So talk to us about how you think manufacturers, because you've talked about the sample being pretty small, fairly large companies. These are some companies that may be assessing the markets to raise capital. What's your take on their assessment of the market conditions right now?
Well, you mentioned the US dollar 1 billion Eurobond. We also know that if you look at the naira-denominated fixed income market, obviously yields have picked up in the last few weeks. So we're 14, 15, compared to say 11, 12, and this is a reflection ultimately of what's going on in the US and the fact that some of the offshore players in Nigeria have left the market. Now, there's no reason whatsoever why they won't come back in the market, but there's a bit of a lull now. On the Eurobond, you mentioned, I think if I heard correctly, just under 6% for the Eurobond. Well, I think
right, for the 5 year.
My suggestion, my humble suggestion, would be issue as soon as you can, basically.
Well, but for me, I think the big question is, particularly even for those that will be accessing the local markets, a higher interest rate environment, a high yield environment for the federal government bonds suggests that it will be quite expensive for many of these companies to borrow. So to what extent do you think this could slow down the growth of the manufacturing sector? Because it's growing at a pretty healthy rate right now. The latest reading was about well over 8%.
Yeah, on the growth of on manufacturing, yeah, last figure, as you say, 8.4% was first quarter, which was substantially above the previous quarter. But 8.4 may be a bit inflated because the year earlier period, of course, was the period of the fuel subsidy, or I should say the attempt to remove the fuel subsidy, and the consequent nationwide protests and consequent certain amount of industrial stoppages. But no, I mean, of course, the manufacturing is growing strongly. And across, well, particularly the most visible side, of course, the consumer goods segment. So if the question is, are the borrowing costs really going to sort of slow down this growth, especially in the consumer goods segment? I'd say no, not greatly. I mean, a lot of these companies are cash rich and have a fairly modest borrowing requirement, and they're expanding, and they're expanding on the basis of their own analysis of domestic demand. And domestic demand, well, we have nothing to, their analysis is private, so we don't see it, but we can assume that it's fairly optimistic, judging by the expansion programs of nearly all these consumer goods companies.